Welcome to the channel, financial enthusiasts. Imagine this. You're sitting on a beach, sipping your favorite drink, and checking your bank account, not because you have to, but because you want to. And guess what? Your account balance just went up. No work, no stress, just money flowing in like clockwork. Sounds like a dream, right? Well, that's the magic of living off dividends. But before you start packing your bags for a permanent vacation, let's get real. How much money do you really need to live off dividends? And is it actually as easy as some people make it sound? Spoiler alert, it's not as simple as throwing $1 million into dividend stocks and calling it a day. Stick around, because today, we're breaking down the real cost of living off dividends explained. Let's talk about Warren Buffett. The man eats at McDonald's every morning and still manages to be one of the richest people on the planet. But here's the kicker. Buffett makes billions every year just from dividends. That's right, he doesn't need to sell stocks or run companies to live. He simply collects checks. Now, before you say, that's Warren Buffett, not me, let's break this down. He didn't start with billions. In fact, he made his first investment at age 11, and his strategy was simple. Buy dividend-paying stocks and never sell. Over time, those dividends grew, reinvested, and eventually, he had enough to live off of, and then some. So, what can we learn from Buffett? That dividends can be a powerful wealth-building tool, but patience is key. He didn't wake up rich overnight. He played the long game. And if you're serious about financial freedom, you might want to consider doing the same. Before we dive into the numbers, make sure to subscribe to the channel so you never miss another wealth-building tip. Let's kick things off with a reality check. Living off dividends isn't about quitting your job overnight and magically receiving money in your account like a scene from a Hollywood movie. It's about building a passive income stream so reliable that you never have to trade your time for money again. Sounds great, right? But here's the problem. Most people misunderstand how it actually works. Biggest misconception? Thinking dividends are a shortcut to instant wealth. That's like believing you can plant a tree today and expect it to give you shade tomorrow. Dividends take time, consistency, and strategy to grow into something that can fully support your lifestyle. Yet so many people fall into the same traps. They assume that unless they have a fortune sitting in their brokerage account, dividend investing isn't even worth considering. Wrong. Dividend investing isn't about where you start. It's about how you grow. A well-planned portfolio can take small, consistent investments and transform them into a reliable income stream over time. They completely ignore the invisible wealth thief known as inflation. The cost of living never stays the same. That coffee you buy today, in the future, it might cost double. If you're not planning for the slow but steady erosion of purchasing power, your passive income could quickly become very active in stress levels. And worst of all, they think all dividend stocks are created equal. Some companies dangle high dividend payouts like a flashy sales pitch, but if the company struggles, those payouts could disappear overnight. Others take a slower, steadier approach, increasing their dividends consistently and turning modest investments into cash flow machines over time. The trick is knowing the difference between an income stream built on a rock-solid foundation and one built on sand. Living off dividends isn't just about chasing the biggest payouts. It's about understanding the balance between risk and reward, knowing which stocks will provide sustainable income, and having the patience to let compounding work its magic. Now let's switch gears and talk about the number that's on everyone's mind. How much do you actually need to live off dividends? Most people assume you need a mountain of cash sitting in a brokerage account, but that's just lazy math. The truth? There's no magic number because the real answer depends on your lifestyle, investment strategy, and patience. If financial freedom through dividends is the goal, the first step isn't obsessing over stock tickers or dividend yields. It's understanding how much it actually costs to maintain your lifestyle. Some people thrive on minimal expenses while others require a bit more. The key is knowing your personal financial blueprint, not blindly assuming you need a fortune. Then comes the big debate. Do you chase high dividend yields, or do you focus on dividend growth? This is where most people get stuck. Some stocks promise sky-high yields, but here's the catch. If a company is paying out massive dividends but isn't growing, it's like milking a cow without feeding it. Eventually, the milk runs dry. On the other hand, dividend growth stocks may start with lower payouts, but they increase their dividends year after year, creating a snowball effect of compounding wealth. And this is where patience pays off, literally. John D. Rockefeller put it best. Don't wait to buy dividend stocks. Buy dividend stocks and wait. Let that sink in. The difference between struggling to live off dividends and thriving on them isn't just how much you invest, it's how long you let time do the heavy lifting. But there's another secret ingredient. Reinvesting dividends early on can supercharge your income. Instead of cashing out those payments immediately, putting them back into your portfolio creates a compounding effect that turns even modest investments into substantial passive income streams over time. This is how the wealthy don't just collect dividends. They use them to build generational wealth. Bottom line, you don't need millions to live off dividends. You need a strategy, a long-term mindset, and the discipline to let compounding work its magic. Moving forward, let's break down a key decision every dividend investor faces. Should you go for high-yield stocks or focus on dividend growth? All right, let's talk strategy. If you've ever researched dividend investing, you've probably heard two conflicting schools of thought. Go for high-yield stocks to maximize income now, or invest in dividend growth stocks that start smaller but snowball over time. It's a battle between instant gratification and long-term wealth. So, which one actually wins? At first glance, high-yield stocks seem like the obvious choice. Who wouldn't want bigger dividend checks right away? But here's where reality kicks in. Many high-yield stocks struggle to sustain their payouts. A company that offers sky-high dividends might be compensating for low growth, financial struggles, or an unsustainable business model. If a company can't grow, eventually, the dividends either stop growing or, worse, get slashed altogether. That's like booking an all-you-can-eat buffet, only to find out half the dishes are missing. On the flip side, dividend growth stocks take the opposite approach. Instead of paying the highest possible dividend up front, they start smaller, but increase their payouts consistently over time. Think of it like planting a tree. At first, it barely provides any shade, but as the years go by, it grows stronger, its branches expand, and eventually, it gives you enough coverage to relax in the cool, passive income breeze. And here's where it gets interesting. Dividend growth stocks tend to outperform high-yield stocks over the long run. Why? Because these companies are usually financially healthy, profitable, and steadily increasing their earnings. That means they're not just paying dividends, they're compounding wealth for you in multiple ways. Let's put it into perspective. Imagine two investors. One chooses high-yield stocks that barely grow over time. They collect steady income but never really see their wealth expand. The other picks dividend growth stocks, reinvests their dividends, and watches their income snowball over time. Who do you think is in a better position 10, 20, or 30 years down the road? Hint: it's not the one who prioritized big payouts up front. Here's the kicker. It doesn't have to be an either-or decision. The best portfolios often strike a balance, blending some high-yield stocks for immediate cash flow with strong dividend growers for long-term sustainability. By the way, if you're enjoying the video so far and want more topics like this, comment the word "more" so I know. Now let's talk about something people always overlook: hidden costs that could eat into your dividend income. Let's take a reality check. Dividends aren't just free money falling from the sky, and living off them isn't as effortless as some make it sound. While it's true that dividends can be a powerful source of passive income, there are hidden costs that can quietly eat away at your earnings if you're not careful. Taxes are the first unexpected hurdle. Depending on where you live, the government might take a significant bite out of your dividends before they even reach your account. Some dividends are taxed at lower rates, while others get hit with higher taxes. And if you're investing internationally, foreign taxes can chip away at your earnings before you even see a cent. If you're not factoring in tax-efficient investing strategies, you might end up earning a lot on paper but keeping far less in reality. Then there's inflation, the silent wealth thief that creeps up year after year. The cost of living never stays the same. That comfortable lifestyle you're funding today could cost a whole lot more in the future. Without a plan to grow your dividends over time, what once felt like financial freedom could start feeling like a financial struggle. And let's not forget the biggest nightmare for dividend investors: dividend cuts. Some companies promise generous payouts but can't keep them up when the economy takes a hit. One moment, you're collecting reliable checks. The next, the company slashes dividends, leaving you scrambling for a backup plan. Relying too much on a handful of stocks without diversification is like building a house of cards. One wrong move and the whole thing comes crashing down. There's also the overlooked factor of reinvestment. Many investors collect their dividend checks and cash them out without considering how reinvesting could exponentially increase their income over time. If you're not putting your dividends back to work in the early years, you're missing out on the power of compounding growth, which could turn small dividend payouts into massive cash flows later on. And let's talk about emotions. When the market crashes, dividend investors love to say, "I don't care about stock prices, I just collect dividends." But when a company starts cutting dividends or when inflation makes those payouts feel smaller, reality kicks in. You need a strategy that goes beyond just collecting checks. You need a plan to protect and grow your wealth over the long haul. All right, let's flip the script for a moment. What if I told you that maybe you shouldn't live off dividends alone? Here's a hot take. Maybe you shouldn't aim to live only off dividends. Wait, what? After all this talk about financial freedom through dividends, why would anyone suggest rethinking the goal? Because the smartest investors know that focusing on dividends alone can actually limit your wealth-building potential. Most people see dividends as the ultimate passive income strategy. Money rolling in, no effort required. What's not to love? But there's a hidden downside that many overlook. Dividend investing, when done incorrectly, can create a false sense of security. If you rely entirely on dividend payments and ignore capital growth, you could be missing out on massive wealth-building opportunities. Think of it this way. Would you rather milk the cow forever or sell some milk and reinvest in more cows? Living only off dividends means you're focused on squeezing out every penny of income from your investments. But what if that same capital could be growing in value at a much higher rate? Some of the biggest fortunes in history weren't built by just collecting dividends. They were built by letting investments grow, reinvesting profits, and strategically using capital appreciation. Here's another issue. Market conditions change. During booming economies, companies happily increase their dividends and everything looks great. But when recessions hit, even the most stable dividend-paying companies can cut or suspend payouts, leaving investors scrambling. If your entire strategy is built on collecting checks, a market downturn could put you in a tough spot. A smarter approach? Balancing dividend income with capital appreciation. Many of the world's best investors don't just hold dividend stocks. They leverage a combination of growth stocks, reinvestment strategies, and even occasional profit-taking to ensure their wealth is not just stable, but constantly expanding. That's the difference between being comfortable and being truly financially free. The key takeaway: dividends are a fantastic tool, but they're not the only tool in the wealth-building playbook. Instead of focusing solely on collecting checks, a well-rounded investor balances dividend income, stock growth, and strategic reinvestment to build an unstoppable financial engine. Now, let's dive into a fascinating historical example that proves why dividends work best with the right strategy. Let's take a trip back in time. Most people know about legendary investors like Warren Buffett, but few have heard the fascinating story of John Templeton, a man who turned a modest sum into a financial empire by doing the exact opposite of what everyone else was doing. While the world panicked during times of war and economic collapse, Templeton saw opportunities where others saw disaster. At a time when most investors were desperately selling off their assets, he was quietly buying stocks in companies that had been all but abandoned. Many of these companies were paying rock-bottom prices. Some were even on the brink of bankruptcy. But Templeton understood something most investors didn't. Markets recover, and dividends from strong companies are built to last. As economies stabilized, the companies he invested in didn't just survive, they thrived. Their stock prices skyrocketed, and their dividends increased year after year. Templeton didn't just make a profit. He built a fortune that allowed him to live off his investments for the rest of his life. What's the lesson here? Fear and short-term thinking kill wealth. Many investors panic during downturns and abandon their dividend stocks right when they should be doubling down. The best opportunities often appear when others are running in the opposite direction. Dividends aren't just about steady income. They're about playing the long game, reinvesting and making decisions that pay off for decades. Speaking of strategies most people overlook, let's break down an uncommon insight that could completely change how you approach dividend investing. Here's something almost nobody talks about. Most investors focus on stock price movements, market trends, and economic forecasts, but they completely overlook the true power behind dividends, compounding through reinvestment. A study found that reinvesting dividends has been responsible for the majority of the total returns of the stock market over long periods. Translation: the real magic of dividend investing isn't just in collecting checks, it's in putting those checks back to work. Instead of spending the dividends you receive, rolling them back into your investments allows you to buy more shares, which then pay you even more dividends, which buy even more shares. And the cycle continues. It's like planting a small apple tree. At first, you get just a few apples, but instead of eating them, you plant the seeds. Over time, those seeds grow into an entire orchard, producing fruit for generations. Here's what most people miss. Dividend reinvestment beats market timing every single time. Trying to predict when stocks will rise or fall is a gamble. Even professionals struggle to win. But steadily reinvesting dividends, regardless of market conditions, creates unstoppable momentum. And the best part? The longer you stay in the game, the stronger the compounding effect becomes. Investors who reinvest dividends don't just earn more. They build wealth at an exponential rate. Now, let's wrap this up with the biggest takeaway you need to remember. So, what's the real cost of living off dividends? It's not just about how much you invest, it's about how you invest. The biggest mistake people make is thinking they need a fortune to make dividends work for them. But the truth? With the right strategy, time, and patience, you can turn dividends into a powerful wealth-building machine. Here's what separates those who truly achieve financial freedom from those who struggle. 1. A mix of dividend growth and high-yield stocks for both stability and long-term gains. Next, a plan that accounts for taxes, inflation, and reinvestment to maximize earnings. Finally, the discipline to let compounding do the heavy lifting instead of chasing short-term gains. The best part? You're in control. Whether your goal is early retirement, extra income, or financial security, dividends give you the power to make money work for you, not the other way around. If this video helped clear up some dividend myths, hit that subscribe button and let's build wealth together. And if you want to see more videos like this, I highly recommend watching my next video, which is the perfect complement to this one. Remember, this video is for educational purposes only and does not constitute investment advice. It is important to conduct thorough research and consult with financial professionals before making any investment decisions. The value of investments can fluctuate, and past performance is not indicative of future results. Always assess your risk tolerance and investment goals before allocating your capital. This has been The Real Cost of Living Off Dividends Explained. Thanks for watching, and I'll see you in the next one.